To maintain the integrity of a financial system, you need to have strong laws, strong regulations, and controls in place to prevent the ill gotten wealth from coming into the financial system. Even if it comes, you need to have controls in place to detect them.
If you work in a company, the accountant lawyers, they will know how the transaction happened, which is legal or not. At the same time, if you want to conceal some money, where you put it? You put it gem, jewelry, where you make your big cash into a small items and the value is still carries.
Now, AML monitoring happens mostly in the banking and finance institutes. What an organization should look at is in terms of what data is being utilized, how these are secured, and how it's processed. And this is what is important in terms of information security as well as cybersecurity, which comes in.
Strengthening anti-money laundering compliance in Sri Lanka. Hello, you're with Echelon and this is Decision Points. And in the studio with us, we have an eminent panel who potentially can address this issue. We have KV Karthik, a partner at Deloitte India. He's a forensic and financial crime leader. Muzawwir Manzeer, president of the IIA chapter in Sri Lanka, and he's also a partner for audit and assurance at Deloitte Sri Lanka. And we have Vengadasalam Balagobi, cyber leader at Deloitte Sri Lanka. Gentlemen, welcome. It's fantastic to have you here. Let's start by understanding the sort of challenge of money laundering and by extension, anti-money laundering compliance. I'll bring you in, Karthik. What are the forces that are shaping the money laundering landscape, you think, right now?
Probably when you talk about anti-money laundering, you need to probably take a step back. You need to start looking at why did this AML laws come into place, right? So we are talking about a situation where probably in the 1980s or 1970s, you had a lot of issues related to ill-gotten wealth in terms of drug money, in terms of other illegal sources, which people used to introduce into the financial system. And to maintain the integrity of a financial system, you need to have strong laws, you need to have strong regulations and controls in place to prevent the ill-gotten wealth from coming into the financial system. And even if it comes, you need to have controls in place to detect them. And that's why if you see globally, the anti-money laundering laws have come into existence from then on, and it's been propagated across the globe, whether you call it with standard setting bodies like FATF, which were actually set up as part of a G7 initiative. It's an intergovernmental body which sets up the standards for anti-money money laundering.
What does FATF stand for?
Financial Action Task Force.
And this is similar. I mean, in terms, I mean, we will all understand financial reporting standards, right?
Yeah.
Are FATF standards similar in application,
Yeah,
or
so-
how are they different?
They are standard setting bodies, so they will give a set of recommendations which are considered something which is very crucial for anti-money laundering compliance. And there are evaluation of countries against these standards. And once they believe that you have achieved a set of compliance on these standards, you can become a member of FATF. The issue is that if you're not in compliance with these standards, there could be repercussions in terms of you coming into a gray list or a blacklist, and that can have a more devastating impact on your economy.
Got it. And before this, we were discussing how Sri Lanka was at one point grey listed by the FATF. Let's come back to that later. But Muzawwir, can I bring you in? Like, look at Sri Lanka's context and what's happening around AML or anti-money laundering. What do you think are, in a practical sense, the challenges that define the issues that define the challenges?
I think as correctly Karthik brought on FATF recommendations, so there are 40 FATF recommendations that we have to comply with. So last 2 times in Sri Lanka, the reviews that we have gone grey listed. So grey listed is actually there is much worse than that, which called blacklisted. So blacklisted means it's totally sanctioned. But the grey listed also, it's pretty dangerous because when you get grey listed, they actually put as our country as high risk. So what happens that we can't do any transactions, right? Export proceeds or whatever, the bank will actually, let's say we do export for a country called, let's say Italy or something. So you want to get some money proceeds.
Just to be clear, Sri Lanka is currently not grey listed.
No,
right?
no, no, no. Because what happened after the last grey listed, there is a national risk assessment have been done, and to showcase that like we have progress and made certain, implementation in terms of law changes, amendments, and all that. We have largely compliant and compliant, right? And based on that, we have been removed from that. Now again, we have another evaluation that's to come in March 2026. We call, actually it's a third evaluation we are going to have it. So at that review, we have to make sure that all those 40 FATF recommendation we are compliant.
So we are facing a review in March, from what you say. Is this routine, or is it because we have been grey listed very recently and there needs to be greater oversight?
No, it's a continuous exercise.
If I may just add to that, gray listing means that you have some deficiencies in terms of implementation of those recommendations. So moment you rectify those deficiencies, you come out of the gray list, and for that you need to they will keep coming for evaluation to your country. But to the point, even if you're a member of an FATF, you still keep having those periodic evaluations, because if you look at the financial ecosystem in the world, it keeps changing. The money laundering scenarios or the threats keep changing. Earlier it used to be cash related issues, then it became trade based money laundering, now you have virtual currency. So there are various changes that keeps happening.
Muzawwir, now Karthik highlighted at the beginning it was money laundering was usually related to cash, then it became trade, and now there's virtual currencies also in play, right? Look at challenges or the contours of this issue as far as Sri Lanka is concerned. Where are we most challenged with?
That FATF recommendation we talk about, right? So the most challenging part is actually the data gathering in terms of, for example, now you should have the banks should maintain correct KYC's informations, right? This is know your
KYC as in
customers.
know your customer.
So earlier, like what you used to do, individual one is not that much difficult. You produce your national ID card, and you get verified, and the people have, these systems have access to verify that whatever the produce informations are correct. But we have a bigger challenge in terms of beneficial ownership for the corporates, right? So what happened for these corporates, they are supposed to maintain, there is a rule in Sri Lanka that more than 10% holding should be disclosed as a beneficial owner. So in order to bring that, there is a Companies Act amendment has happened, and actually the speaker signed off on 4th August if I'm not mistaken, and it's yet to be gazetted. So once it gazetted, what happened, that law become mandatory, and to maintain all the beneficiary owner list by there are systems are going on this, and where the company registrar should provide it, and the company secretary is supposed to update these informations regularly when there is a changes happen. If they don't properly maintain, if there is any incorrect information disclosed, it goes to penalties.
So the company or the company registrar, the company secretary has to maintain a beneficial ownership register.
Correct.
Right.
Correct.
And the penalty for not having accurate data is on the company secretary, not so much on the company, is it?
Actually, not the company secretaries. The company secretary's authorized director will be responsible for that data maintenance for that. So that's actually something is new for everyone, right? So it's still actually all are exploring this act and the practical implication. That's what I said, like, because one of the difficult part of FATF recommendation is actually bringing that beneficial ownership details. Because if a corporate is making a transaction, they want to know the ultimate beneficiary owners, because any person can go and hide in a company and do whatever the transactions. So identifying individual transaction may be easy than a corporate. So then they want to identify. Now there are a lot of, let's say if you take a complex corporate structure, there are so much of parents, subsidiaries and transaction involved, and for a money laundering transaction to be identified, you need these informations, which is very critical to profile and a system to work.
Gobi, let me bring you into the conversation now. It's now emphasized that some of the challenges around money laundering are because of the data. Transactions today aren't what they used to be 20 years ago, certainly not very different to what they were 50 years ago, right, when things were much simpler. From a company perspective, how should they start approaching the challenge of data? Assume they want to be compliant, assume they want to be, as a result, able to deal with anybody anywhere in the world and be seen as very credible. How does a company get about this?
Okay, if I put this across in terms of two ways, right? If you look at now, AML monitoring happens mostly in the banking and finance institutes, right? If you look at most of these organizations are required to be information security compliant or maybe ISO 27001. So which gives them internally the security confidence to external parties as well. Internally, they make sure that all requirements of the standard is embraced. So that's one point. And in terms of securing the systems, let's move into the AML side of it. Again, what an organization should look at is in terms of what data is being utilized, how these are secured, and how it's processed. And this is what is important in terms of information security as well as cybersecurity, which comes in. And this is mainly, if you look at locally, most of the organization, they do have two folds, like they have their core banking systems, and they also have a data warehouse in between, and they pump or they push the data of transaction data and then do the transaction monitoring part of it. But in these two areas, if you look at how you're going to secure your core banking system, where you have correct data and accurate data, which is going to be pushed into your warehouse, and then which is again need to secure your warehouse as well in terms of who has access to that, how those informations are stored, and you can't be giving access to everyone, and they should not be external facing node or server, but it should be internally, and where none of the external party could get in, and that need to be blocked. So it goes through the full flow of the information flow until the transaction monitoring system, that is AML transaction monitoring system.
So in usual parlance, we've understood that anti-money laundering is one that usually concerns the financial sector greatly, right? But is it exclusively so? Now Gobi is referring to the two-tier vulnerabilities, right, at the core banking system and at the data warehousing level in financial institutions. Muzawwir, is anti-money laundering primarily a preoccupation of the financial sector, so to speak?
I think Karthik is the good person to answer for that.
To be honest, it's no. The answer is, if you look at the FATF recommendations as well, there is something called as DNFPB, designated non-financial bodies as well. What does it mean? It means that, yes, we always used to consider financial institutions as the gatekeepers for all the financial transactions. But then over the period of time, whether you look at the vulnerabilities of money laundering, where all can it come from? And that's where your regulators and FIU also undertaken a national risk assessment. So what they do is they look nationally, identify which are the areas which are vulnerable to money laundering. If you look at it globally, DNFPBs include lawyers, accountants. You look at casinos, gems and jewelry traders, real estate. These are considered as areas which are very prone to money laundering. Okay, so it's not primarily
sorry to interrupt, trust and company service providers also in Sri Lanka has been considered.
Yes. So when you look at regulations, and in fact in Sri Lanka, they have also included most of these DNSPBs as reporting entities. So what does it mean? It means that all the laws that are applicable for financial institutions, which we are thinking, the same obligations are now on these entities, which are considered as reporting entities, to put in place a compliance mechanism and report any suspicious transaction to the FIU.
Is it applicable in the same intensity? Now we understand how, for instance, the banking regulator would very piercingly look at the financial sector. Who is going to do the same for these DSNPBs?
Yeah, designated non-finance businesses. Yeah. So actually, first of all, we understand that why this designated non-business, because if you take accountant, lawyers, and they know like first information, they will know like how the money laundering works. Like if you work on a company, the accountant, lawyers, they will know how the transaction happened, which is illegal or not. At the same time, if you want to conceal some money, where you put it? You put luxury assets, right? You put it gem, jewelry, where you make your big cash into a small items and the value is still carries, right? So that's why actually these entities are get profiled. So that's the first understanding we should have why these were like profiled. So whether transaction happens on these companies, anyway, they have to maintain the records of them in the bank they have to maintain. So then when the transaction happens, then it's get triggered like, okay, now for example,
Let me add to that. Okay, the principles behind AML compliance are the same, whether you look at financial institutions, non-financial institutions. What do they need to look at? They need to look within their business, identify what my risks are, because the regulator in the country, and there will be different regulators. You will have a banking regulator, you will have a different regulator for real estate, you will have different regulators for casinos and others. That will be decided by the government, by them, and they will come out with the guidelines that they need to follow. But all guidelines, if you look at it, follow, there are four pillars
Okay.
of compliance. Okay, the first is you need to know what is the risk in your business. Okay, because you follow a risk based approach. Okay, you say this is my highest risk area, so I need to monitor it more carefully. It does not mean that the low risk areas you ignore, because compliance is not an option, but it's like a risk based approach. Okay, so you need to know what your risks are. Second, you need to look at the onboarding. So for example, if I go to a casino, I am a customer, right? Like I go to a bank, so they need to know who I am. I'm coming. So the talking about know your customer principles do apply there. Okay, then I look at what kind of transactions happen. So in a bank, I might do it through a banking account. If I look at casinos or real estate, I'll do a real estate transaction, or I might do in casino, I might put in money and play games, right? So that's the transaction. So that transaction monitoring needs to happen. The principle behind is that I, as a customer who I have come in, I need to look at my transactions to see if it fits my profile. So if I had to give a simple example, in a banking parlance, we can relate it to others as well. I am a salaried person, right? So if I come and open an account with you, the bank will know that at the start of every month, I'll get a particular salary, which you will know. I will have certain expenses that I make in, right? So this is a normal pattern of transaction. What they need to look at is that pattern being disturbed. So for example, tomorrow I start getting a lot of cash deposits in my account besides my salary. That could be that I'm doing some other business. So what the bank needs to investigate is to find out, look at my profile and say, hey, what are you doing? Are you doing any business? Where is the source of money? And then look at my transaction to say, it does it match? So I might have started a business or something else, right? I might have rented out an apartment, I might be getting cash, which might be getting deposit, or whatever could be the reason. So transactions should fit your profile. That is what they need to look at. Anything which does not fit the profile, they expect it to be reported to the FIU. Then so the banks or any other institutions are not an investigating agency. They believe that it does not meet the profile, it sounds suspicious, they need to report. Then the investigations will happen by the investigating agencies in the country.
Right. So does this go beyond banking? For instance, now let's take Take insurance. Somebody
Yeah.
may
Yeah.
obtain a large life insurance
Yeah.
policy,
Yeah.
because they want to hide some
Yeah.
money.
Yeah.
How does the system work there?
Yeah, it's very simple. I'll give you a simple example. If I have to take a life insurance, why am I talking not even about a large insurance as a one-time payment? Okay. I may take a large insurance, I'll say a 15-year insurance, right? I pay premiums. If I pay premiums in cash, let's assume, okay, I might buy premiums today. And this is the process of converting my ill-gotten wealth into a legitimate source. That's what money laundering is all about, right? So I go and buy an insurance. I pay my first premium. I pay my second premium next year. I might use cash or through some other source to pay that. After 3 or 4 years, I might say I'm canceling that insurance. What happens? They pay back the premium to you. So what I have done, I've converted my cash or ill-gotten wealth into a legitimate source. So when you look at insurance, whether you look at capital market transactions in shares, somebody is pumping and dumping shares, where is the money coming from? So there are various scenarios in which it can be done. So the scenarios that you will look for in an insurance company, they have a set of scenarios which they will look at. Tomorrow, similarly, for a bank, it will be different. You look at casinos, the kind of scenario that to what Gobi mentioned in terms of what they need to put into your transaction monitoring system to generate those alerts will be different. That is why I said the first thing that you need to do is to look at the risk within the organization. So you call it a risk-based approach. It's like what is the saying in Alice in Wonderland, right? If you don't know where you want to go, it doesn't matter where you go. So it's like saying this is my risk and this is what I need to put into place to manage and monitor those risk and compliances. So as simple
Add
as
on to
that.
Karthik, like industry wise, it's different,
Yes.
right? That's actually we have to profile. Industry wise, it will be different.
Yeah, because some industries may not have regulators, or there are professional bodies largely overlooking them. So are they as effective?
Now, for example, I will tell you, like, okay, when did you open your bank account? At what age you have opened?
Maybe 19 or
What
20.
what was the profession you would have mentioned?
I would have mentioned that I was a journalist back then.
19 years journalist.
Yeah, more.
Now let's take now. Okay, then still you are journalist then, right? But for us actually,
No, I mean my role in
Yeah.
the organization
Yeah.
is very different.
Very
to what
different.
it
You would
was.
have moved from a salaried journalist
yeah,
to his own
now
business
I'm
person, right?
Now let's say I open as a graduate or maybe student, right? Now I am actually a partner of organization, right? So at age of after 20 years, but forget about 20 years. But I became an accountant role at the age of 23, 22. Still, my bank account would have been in student.
Sure, category.
Still I'm carrying the same, right? Because see the risk profile we were talking about. So if you see, if those changes were not timely made, imagine how you can profile these people. If you open account long time back and it's not keep on up to date, the people, especially lawyers, they may be students or maybe graduate, they became lawyers. Likewise accountants. So certain professions after ages it may be changed, right? Time to time they changes make, but these are not timely updated.
The onus is on whom to make sure this is it only on the institution to make sure they can assess the risks, or have the correct profiles?
Actually speaking, it has actually responsibility on all the people's side. Now let's take, I used to say that we talk money laundering as a technical subject and all that. Actually every home, wife and a mother should ask from a husband or their children, where is the money coming from? Is the legal or illegal way they are earning it? Actually, if that questions
I will
resolves,
probably answer it slightly more differently, how it happens across the globe as well, right? So like you said, you're right. Every industry has some specific risk. So if I go to a casino, it's a different risk. If I go to a real estate, it's a different. Gems and jewelry, it's a different risk. Banking and financial institutions, a different risk. What usually they do is there's something called as a concept called as public-private participation and a thematic study. So what they do is in that particular domain, the organizations will look and identify what are the common risks for me. So, for example, in let's say in a bank, I will say that okay, for a bank, my biggest risk, let like what you'll see in your NRA as well, is that I think they have identified Hawala as the highest risk, but then they will have classified different products that the bank offers, like a trade finance product. They have classified as a medium risk. So they have done a thematic study, identified which are the risks, which are the highest risk. Similarly, every regulator or industry body, whichever is responsible for regulating, they have a private partnership to identify the risk industry, and that's how the evolution starts in terms of what are the controls that we need to put into place to manage those risks.
Shamindra, let me get into in terms of privacy requirements, right? As you know, Personal Data Protection Act is almost in force, right? And there is a data subject right, have their information valid, current, right. So this right has not been exercised as yet. That's one of the right of a data subject. Data subject means a person
Whose data is being
data
stored,
stored
in
in
a
system, any system. Now, for this question, what you asked previously is mainly, now let's say Muzawwir's or my positions were not changed, right? So I have been a trainee long time back, and then it may be still the trainee, right? But what happens is systems doesn't throw out reports to say, these guys KYC are not being revived or revealed for a longer period. Monitoring and review should come out. So otherwise, you what happens is you also, in the meanwhile, you also give them other products. Example, let's say you give a credit card, right? So when he becomes 23, I become 23, I got a card, right? So they look at my salary. So then the KYC should have been changed. And also on the other hand, the moment my salary goes to the account, my revenue on a monthly basis, the credits would go up. Obviously, account manager or whoever is handling my account should call me back and ask, okay, sir, you're getting so much of money. Is there any change in your career, or how do you get this? This is what KYC is all about, right?
So
I
actually,
feel that part doesn't.
Yeah. Actually, I would like to add to what Gobi said. Now, okay, we talk about a very subject matter banking, opening a bank account. The problem is we don't maintain our bank account in one bank, right? Let's say we open as a student or whatever one bank, and let's say one credit card company is giving a credit card, it may be a different bank. So then where that credit card offering will update my all the latest KYC details, where my original bank account I open will have my old details, right? And there will be another, maybe after 3 years I may get a loan or maybe a car loan in a different bank, so they may have my latest update, right? So then I have 3 bank accounts, I have 3 type of KYC information. So imagine if a very clever person knows that I know this bank only have my latest profile, which is profiling to my anti-money laundering risk profile, and whatever the transaction makes, what he said, like, okay, how you get this money and all, they may be not calling you. So then I use the other bank accounts for other purposes where I have not profiled as a high risk customer, and where we call it actually the due diligence need to be made for the high risk customers, right? Whatever the profile we were discussing. So that will never happen for those normal bank accounts. So I think actually Karthik has a very good suggestion for this, to bringing how we can bring all these together.
What is that? So
Yeah,
because
I'll
our profiles are in various places.
Yeah, see, I'll add to the other point which we also often overlook. We keep talking about compliance. Yeah, compliance is something which is not an option, right? But it's also, let's also understand one aspect of it. There's a cost associated with the compliance for every financial institution, right? So, for example, if I say I have to do a KYC, I have to do a transaction monitoring, I need to implement systems, I need to have people to review the alerts that gets generated because of that. And if you look at it, the number of alerts that get generated to the number of STR that will be filed will be in fractions, right? So you need to have manpower to look at each of those alerts that get generated and say it is suspicious, not suspicious. That's a cost.
Let's just dumb this down, Karthik. So you're referring to alerts, say It's assume this is a financial institution, and it's
It's
the
true for
system-
everybody. It's true
yeah.
for everybody, even
And
tomorrow.
the systems there are generating alerts saying, check this transaction, check this profile, this doesn't match the risk.
I mean, let me put it in a very simple parlance for you. Okay, you have a cash transaction reporting threshold, right? If I have cash deposits or withdrawals beyond a particular amount in a month, aggregate it. If it is below, if it is beyond that particular threshold, you need to report. That's a plain simple reporting. That's nothing bad. But if I'm a money launderer, what will I do? I will try to keep that my transactions level below that threshold. Okay, so let's yeah. So for example, if I say that 10 million is the limit, let's say for argument's sake, for cash transaction reporting, I will try to keep the transaction below the 10 million. It could be 9 million, it could be 9.5 million, it could be 8 million. But I'll do multiple transactions. I'll do it month on month. Okay. So when I define my system, I will generate alerts. I'll say anything less than 10 million you should generate. Then it will generate 100,000 alerts, because anybody who has done even 1 million worth of transactions will get reported, right? But what do I do is then I create a threshold and say that I need to monitor anybody who does it multiple times in different months. I mean, multiple months consecutively it's happening between so and so. And then what is the risk profile of that customer? If it is a salaried person, it should generate. If it is non-salaried, then probably I might know that he does a lot of those cash transactions. What is his business? So for example, I might be a what we call as a grocery shop owner, which I'll do a lot of cash transaction. But if I know his turnover, which is say 5 lakhs, 6 lakhs, or 8 lakhs, then I know that whatever he's doing is within his limits. So if I don't update that information, and as I said initially, what is suspicious transaction? A transaction which does not fit my profile. So if I have an updated profile, the number of transactions which will get flagged off as an alert will get reduced. So that's what I was talking about. The cost associated with anti-money laundering compliance is what I wanted to bring about.
Right. Bring you in here, Gobi, on the cost associated with compliance, right? Security is one aspect of that cost too. The more data you store in those databases, the more costly it is. Plus, you had to have the core systems to access that data. Is this proving significant for organizations? How should organizations approach this?
Now, as Karthik pointed out, compliance is not good to have, right? You need to have
Is a must-have.
must-have, right? So, irrespective, right, whether there is a cost or not, there
You have
should
to
be.
do it.
It's two things. Like, if you look at having a system throughout, and you, let's say, you build AI on it as well, then you're trying to reduce the cost of resources. But in terms of technology, your cost goes up, right? Or you have mitigating controls in between, and make sure that you have more manpower in terms of monitoring this. So these are two costs that can happen. But if you look at in terms of evaluating a suspicious transaction or identifying it and detecting and reporting, it's not real time, right? Generally happens in locally or Sri Lankan based. I think mostly it happens on a day-end basis, because it goes to the warehouse, and from there, data warehouse, and then it's reported. So if you want
So
something,
that's how it happens in financial institutions, not at the core banking core system.
it doesn't have in the
It
core
goes to the data warehouse, and then it's at least 2 hours later that it gets
Yeah.
flagged.
Yeah.
Right.
So if you want everything real time, then obviously technology cost goes up. Right. So that's a call that the organization take.
Are you suggesting real time is better?
It's better because your transaction monitoring or detection effort could be lesser. And then if you build AI on that, it will be very much lesser. I think Karthik could
Yeah,
add to
I
that
have
as
a
well.
different view on that. I'll tell you why. Because in fraud, see, when we talk about AML, if I just broaden it further, we call it financial crime, right? It could be fraud, it could be cyber-related one, and of course, money laundering as well. The basic principle for fraud risk management is that I lose money, right? So I need to monitor the transaction in real time so that I prevent a fraud from happening. Okay, because otherwise somebody loses money, the bank will have to compensate or whatever it happens, right? So I prevent a fraud from happening. In a money laundering, there is another aspect. Yes, I mean, I don't especially when I look at transaction monitoring, that's a different. If I believe a money launderer wants to open an account, I'll try to stop him from opening an account. But the other thing is suspicious transaction reporting. That means he's already an existing account holder, he's doing a transaction with the bank. My job is to report that transaction to the FIU, that I believe this is a suspicious transaction.
FIU
If I
is
s-
in Financial Intelligence Unit.
Yes, that's correct. That's correct. The problem is that if I stop a transaction at that particular point in time, there is a risk that that money launderer may understand, that may get suspicious that I'm getting monitored, and I may get
Onto him,
yeah. So there is a concept called as tipping off in AML. So you need to ensure that you don't tip off that money launderer of what you might be doing. Usually, what you call as a post facto reporting that happens in AML. But to Gobi's point, it may not necessarily be real time, but there are expectations from the regulator that you cannot continue for eternity. Once a flag is generated, I'm investigating, I'll report after a year. So the expectation from the regulator is you need to do it in a short period of time, maybe week, 10 days, or whatever they look at it, as long as it takes to reasonable time to investigate that it is suspicious and report it. So it's usually end of the day kind of transaction, not usually real time.
Muzawwir, let me bring you in about Sri Lanka's circumstances. Look at Sri Lanka's laws dealing with financial crime in general. And somebody out there may be interested to know how comprehensive the framework is, how rigorous the regulation is, and where are where are the challenges in this landscape? If I am a financial institution, what are the challenges that underlie in this framework?
Actually, under the framework now, if you see, there is a Convention of Suppression of Terrorist Financing Act, Prevention of Money Laundering Act, and Financial Transaction Reporting Act. Those are the acts actually broadly was there. And now actually, in order to make sure that FATF recommendation to be complied, there are several other acts have been coming. One is actually Proceed from Crime Act is already in place, beginning of the year it came. If there is a money laundered assets being identified, so to seize, prosecute, to execute, we have now an act. In the past we didn't have, now we have. So that was actually part of FATF recommendation. And the next amendment came on the Companies Act, I think previously also I mentioned, right? So that is also one of the key, because key recommendation that we have to be comply with before March 2026 next evaluation. We have to show progress on that. And also, there is a casino amendment also to come, and as well as the real estate also, they are bringing some amendments to that. So it's yet to come. We are progressing very well in terms of the FIU unit actually taking actions, and the reviews are happening. And because first of all, the requirement is the framework need to be put in place, and the second is the implementation. That means the effectiveness also to be looked in, because it's like this. You can't just have the signals and traffic signals, everything, and if our people don't stop it, we have to put policemen to stop it, right? It cannot be in that way. So we put the framework in place, at the same time the people need to follow that as well. So I think that is where we stand at the moment.
We were talking about the FATF review. There's certainly one coming up.
Third evaluation is coming
several months from now, right? How does Sri Lanka stand right now? I mean, in the context of what you just mentioned, you mentioned that Sri Lanka has introduced several new laws and updated others, including the Companies Act, right? In your view, how does Sri Lanka stand?
Yeah, actually, it's a bit challenging, I would say that, right? So, though we put all the laws and stuff, and I think there is a retired, I think, Supreme Court judge also put in place to, in order to see these, whether these implementations are coming in place. And FIU unit is actually doing inspections of these institutions and all that. And I think one of the important point what Karthik mentioned also on that designated non-bank one. Now, if you see the bank, finance, insurance, they already had some system in place, and you have some way to monitor this transaction, and they were familiar with all these things. But I think not only Sri Lanka, globally also, the designated non-bank, that unit, that entities, there is a challenge actually bringing them into this framework and make them comply, right? Maybe Karthik, you can
I
add
look at
in.
it from a different perspective. To understand where we stand, we need to understand how an FATF assessment works. Okay, so an FATF assessment works at two levels. So one is a technical assessment, what they call it. What they look at is they look at what do you call as the laws, the framework, the regulations in the
Yeah,
country to
technical
see,
compliance.
do you have that framework in place, the laws, regulations to comply with the recommendations of FATF. Okay, so in that thing, you obviously have now your DNF, PBs, and everybody included. The second step of that assessment, they call it as immediate outcomes. Okay, what they do is then the assessors, when they come to the country, they will probably visit a few of those institutions and others, interact with them, and that is what Muzawwir talking about. While you have guidelines given in place, the rules given in place, do the institution understand what they need to do? How are they implementing it on the ground? So the crucial aspect is usually many of them will have that regulations and technical compliance to a high degree. And I think one of the areas that they were looking at was obviously the beneficial ownership, which was pointed out as one of the key deficiencies. They have brought it up, now it's getting into an operational phase, so that's fine. Now it's the challenge is to get everybody together to demonstrate that it is effectively working on the ground, and that is where the work, the next 28 weeks before the assessment starts, is where the
Gotta show the
majority
progress.
of the efforts will go into.
Right. In that context, can you tell us how money laundering usually happens, and how the framework that we're referring to here, including the updates we've done to several laws and introduced new ones, what are the stages of money laundering? What is the typical type of money laundering, and how these legal changes aim to address that?
See, there are three steps in a money laundering process, right? The first step is the placements layer, they call it. The second layer, they call it, is the layering of the transaction. The third is integration. So what does in the first step involve? Okay, when we talk about the placement layer, what I'm trying to do is I'm getting my ill-gotten wealth into my financial system. Let's say I'm into the business of drugs or something, so I generate a lot of cash. And the problem is, how do I get it into the financial system? I can do it through multiple ways. If I'm looking at a bank, I'll open multiple accounts in different names, keep depositing a little here and there. Tomorrow, if I have to look at real estate, so I can buy a house, okay, I might pay it through cash, or probably significant portion of it through cash, and then say this asset is mine, right? And then I can mortgage that asset tomorrow to a bank and get it, this thing. Similarly, you have these gold loans that come about, right? Pawn shops. So how do you look at how did I buy the gold, right? So tomorrow I go and pawn the loan, and then probably I have introduced this thing into this. So that is where the placement happens into the system. The second step is layering. Why do you do a layering of transaction? Is I want to distance that origination of that money from the proceeds of crime. So I will try to do so many transactions across, so that the distance from the origination becomes so high, it's very difficult to trace back to where it started from.
Once you get the money into the system,
Yes.
you do transactions.
Yeah. So for example, I will introduce, say for example, I open 10 accounts. From those 10 accounts, I'll send it to another 10 accounts, and then I'll aggregate it at some other place and do multiple account transfer. The other way could be that if I can use shell companies to open accounts, put the money through them and transact it. I will never know who the beneficial owner is. And finally comes the integration, when I'm actually legalizing that money. So for example, when I say that I have done all these transactions through multiple accounts, finally I get it to an account like Muzawwir or Gobi's account and say that, hey, this is coming from a legitimate source in a financial institution, so it should be legitimate. So that's how I'm trying to legitimize. The same thing happened, let's say, in casino. If I use a significant amount of cash to start playing, and then once I win, then it becomes legitimate. So when you're looking at laws and regulation, that's why you have a two-step process. The first step process is KYC, where we keep coming back to know your customer, right? So for example, when I know your customer, I say, for example, I have come to a casino to play, for example. Okay, they are reportings as well. So if I bring in cash above a particular threshold, I need to report, right? So when I know that Karthik has come to play in a casino, he's bringing a lot of cash, it gets reported. So then the intelligence unit knows that he's somebody, Karthik, and they know obviously my identity because I have done my KYC, right? It's not an anonymous person. They know Karthik has come and put in so much money to play around. So that gets reported, it can be investigated, and then they can call you up and say, where did you get that money from? So that's one way of preventing, if I can say, my financial system or other systems to be used for money laundering. Then the second aspect comes is obviously in transactions. When I'm doing that layering of those transactions, right? Once I introduce that money and then I have done multiple transactions, does that transaction make a business sense? For example, if I have opened an account, I have put some money into this account like a cash or something, I transfer it to Muzawwir, let's assume. Why do I need to transfer it to Muzawwir? What is my relationship with Muzawwir?
Business case is not.
I am saying, is he in the same line of business? Probably not. Then it should raise a act of suspicion. So what we are trying to do through transaction monitoring is, one, whether it fits into my profile. I mean, do I generate enough funds or wealth to do so much transaction? And the second is the transaction making sense with the other counterparty that I'm trying to do. And then you try to say, oh, this is where I can identify this. So when you look at the layers of AML, this is how a regulation tries to prevent or probably detect money laundering.
So the three layers you're talking about, getting the money into the system.
Placement, yeah.
Placement, layering, you layer it and you switch it around, and then you
Becomes legitimate, integrated into the
integrated
financial
into the financial system, right?
Smart.
I'm trying to see if how from an operational point of view, Gobi, a financial institution. So it's not immediate transactions. Also, there's history here, right? You have a data warehouse, and sure, your today's transaction is also linked to a history of transactions which are now warehoused somewhere. What's the challenge this poses? Because this is not an immediate. Can this raise alarms in institutions when transactions are in several different places?
Yeah, because main thing would be in terms of technology cost. That's one. But apart from that, if you look at analyzing or patternizing the history. Now, if you look at example what Karthik brought in, it could be in different banks or different financial institution, right? Now, if you look at collating to one bank or one institution and analyzing its patterns, it will be time consuming, and there's nobody will share info, right? So that is where the issue comes in terms of understanding about the patterns and understanding whether the monies were received from one particular party and why it is. So that the issue is already there. And also, if you look at retention of these history of data, generally in a bigger bank, you will have about per day, you will have about 200 or 300,000 records, right? So of that, it'll be 10 to 20% could be about $1 million value. So which is a suspicious transaction, right? So that holding those would be again costly. So there should be a mechanism in terms of having them in an archive or whatever, like if they want. I think as a regulation or FIU unit should come up with something like, having a common institute where they could have all these data pumped in, like, example like crib, right? You have all the credit info, which will give you in terms of any bank You walk in, and if you want to get a loan, you get a crib report to evaluate your credit worthiness, right? So that kind of mechanism, I think that will.
So assume, Karthik, that I am a financial institution and I'm kind of fairly sincerely determined to get to the bottom of this case. So make sure that not in just in spirit, but in actual fact, I am compliant. How do I approach something like that?
Actually, I sorry to interrupt, Shamendra, because earlier we were discussing about something about centralized KYC system which India has, right? So I mean, like what he mentioned, they
The
have
challenge that Gopi
yeah.
just brought up.
So
Yeah.
maybe I think because we have to get the international. I mean, what other countries does that, what we can learn from there. Karthik, I think.
How did this come about? When did this happen?
See, when I said compliance is a cost, right, at the start, the thing is, one of my biggest costs is I need to know who my customer is. So when I go to open an account, when you have gone to open an account, they'll ask you for ID document, they'll ask you for address document, and depending on your risks, what they consider, what's your source of fund, and other stuff they ask. The question is that every time I go, I need to give that to different institution. That's number one. Number two is that over a period of time, based on my risk, I need to refresh your information. That's what we spoke about earlier. It takes time, it takes manual efforts, and of course, the cost associated with it. So, the central KYC system, which has been designed, and there are various models for it, whether it's run by the central government, whether it's a public private partnership run in private institution, there are various models for it. The basic premise of all of this is that there is a body which stores my KYC information. So for me, if I had to say Karthik, what is his ID, what is his address, and blah blah blah, whatever information I need to give, it's given. If it's a corporate entity, it will tell you, okay, it's an ABC Limited. These are the beneficial owners of those entity. Everything is stored. Tomorrow, when another bank wants to open an account, then they can leverage on this information which is available in the central KYC to do that onboarding. Whether they can rely on it, not rely on it, that depends on how that entity is structured. So you at least even if you cannot rely on it completely, at least you can source it and then get it verified from your customer. So the effort to reduce that cost of compliance of onboarding a customer is reduced by a central KYC. Similarly, when I had to do a re-KYC, I had to go again chasing a customer. So I'm sure a bank must have sent you hundreds of mails saying that, can you give me your information, which you're not bothered to reply. I also don't do that, right? So in this central KYC, it will ensure that that updation happens. Whenever an updation happens to what Muzawwir is talking about, if I had opened an account with another bank, with my different details, it gets uploaded to my central KYC and it gets pushed back to all the other institutions. So everybody is with the latest information. So this is what a central KYC does, and it reduces the cost of compliance. It provides a standard, what should I say, as a
Quality information.
quality of information which is standardized, not only standardized but also up to date, if I can say, for want of better
How
word.
did this come about in India? Was it did it go hand in hand with the digital ID initiatives?
Yes. So the core, what should I say, is we have something called as Aadhaar, which for an individual, it helps you identify that individual, right? So obviously that formed the backbone of the central KYC, but it does not mean that I cannot open an account without an Aadhaar, right? I can open with my tax ID as well, or some other ID also. So what it does is there are multiple, what should I say, back-end processes wherein this central KYC system will take that information, whether you give me an Aadhaar, whether I give you my PAN card. So if I want to say play smart, I'll go to a bank and say, hey, I don't have an Aadhaar. Okay, I give a PAN card. Another place I go and give an Aadhaar. Okay, and third place I have gone and given PAN and Aadhaar. But the moment all three come to one place, I can dedupe and say that, hey, this is the same person, right? So there has to be a backbone, but does not mean that there has to be one ID. There are multiple ways in which there are multiple IDs which are applicable. It's just that it has to be it will sink in, and also more importantly, it should have a good backing in terms of it cannot be easily should I say as faked or manipulated easily, right? Then you can do that
So,
easily.
so let's come to my question now, which is, okay, if I am a financial institution and I'm determined to be 100% compliant, how do I get about it? Not just a financial institution, anybody who's exposed to these risks and determined to be compliant. Where do you start?
To be honest, I mean, you don't have a choice, right?
Right.
You don't determine that we have to be compliant or not, right? You have to be
You have to be
compliant.
compliant.
But having said that, that's why I said the 4 pillars that I started with in terms of risk assessment, due diligence, transaction monitoring, and reporting. This is something which is the base of
It's
everything.
must actually.
That's
There is
must.
no way.
Okay. But let me add to your complexity, if I may. Okay. We keep talking about money laundering, right? AML. But if you look at the terminology, it's called AML and CFT.
Yeah.
That is counter financing of terrorism. So the difference between AML and CFT is that in money laundering, I introduce ill-gotten wealth into the financial system or any other system to make it look legitimate. But in financing of terrorism, the source could be legitimate, but it would be used for terrorism purposes. So when we're talking earlier about thresholds and others, it may not necessarily apply to a CFT scenario, while it might apply to an AML. Because I mean, if somebody is doing 10,000 Sri Lankan rupees as money laundering, I may not even bother to do that, right? But the same thing when it comes into a situation when you talk about CFT, it gives a different dimension because it has a different repercussion. So when a bank or a financial institution or any I'll probably call it a reporting entity for want of better words, it could be bank or others, they need to be cognizant of both the facts. So you may have a set of rules, methodology for AML, but you also need to be compliant with CFT methodologies. So I'm just adding to the pain that all of them have to. Yes.
And then how does one, I mean, who's unsure about their level of compliance? Yes, you have to be compliant, but let's assume I'm unsure. I don't know whether my systems, my alerts are adequate. Are they working? How do you get about that?
I just put a simple example for that. Like, okay, how we see we are fit?
We feel okay? No pain?
We do a medical checkup.
Okay. Right.
Same here
Right.
also, right? So you can do a review and to do your own risk assessments, and where maybe you can get involved a consultant, experts, to do a review whether you are compliant with all these requirements, and they give you a review report to say that yeah, you are there or not there, right? So then the level of improvements, what need to be done, will be identified. So that, like, you get the report and you go to doctor, they will say that you are fit or not. It's the same thing actually.
Yeah, so usually in any compliance, there is standard principle. They call it 3 lines of defense: the first line, second line, and third line. The third line is usually supposed to provide assurance to the organization to say that everything is as per the regulations. They have proper controls which seem to be working. But what many of the organization, to what Muzawwir was talking about, was they ask an independent third party to do something called as a model validation. Okay, what does a model validation mean? And we do it for a lot of other institutions. Is one, you have your regulations. From your regulations, have you got your policies, process, framework in place which are in line with those regulations? That you need to look at. Then you have done your risk assessment. Then you look at whether that risk assessment is fitting into your controls, what you have put into place. When you implemented a transaction monitoring system, does it cater to the risk that I went with? Because I might have identified a risk which is X, but I might have implemented a transaction monitoring system which is looking at A. I mean, I don't want looking east talking west, right? So I want to ensure that it's all in sync. From your regulations to your risk assessment to your monitoring mechanism, you do that validation. And more importantly, you may have implemented all the scenarios we are talking about, but do you have the data to run it? Well, like he talked about, and that's where the quality of the data becomes very important. If I don't have good quality data, if I don't have data, I might have implemented my system, but it will not necessarily be effective in generating the types of alert that I want to monitor. So that model validation will take care of all of this and give a report to them, which what we call as the health of the compliance is something that can be known.
And to Karthik's point, now let's say I just spoke about AI, right? Now, if the data is not clean, you won't get the output that is required, right? AI may mislead you in terms of taking action or monitoring or things like that. As long as you have clean data, that is where the point should start with. And then also to make sure that data governance in terms of the storing these data. Example, if you take classify those data in terms of identifying what kind of data those are, whether it's personal, confidential, public kind of thing, right? And you apply controls over that, who has access to that, and make sure nobody have access, excess access kind of things, right? And you don't expose them to a external party. And if you are doing patching, make sure you do a patch outside that system. And once it's sees okay, and then you transfer to your production system. So that's one. And if you look at these days, you had these WhatsApp hacking, that is taking over your account, right? So there have been a lot of instances where funds were transferred.
It's like ransom, we call it.
It could be kind of a ransomware as well. It's mainly you, let's say you been compromised and you share your friends, right, saying that I need to pay some money to X party. I'm unable to do it. Could you transfer money on behalf of me? But apparently it's not actually you, right? That also could be two types. One could be money laundering as well as CTF, right? Knowingly, unknowingly, you're doing it, right? So I think Karthik could add to that.
That's a very important point which he brought up, and that's when you asked initially what are the focus areas across the world on them. One of them the terminology which we call it as mule accounts. So basically, what you have is an account which gets used for money laundering. So it could be, and there are multiple things. I could open an account using fake ID and then use those things, or it could be an account which has been lying dormant, nobody knows about it, people are misusing it, or I could have given it to somebody to
Operate it and use it,
play for some consideration, right? That is where the question, and regulators across the globe are also looking at, is there a link between fraud and AML? Okay, because at the end of the day, if you have fraud or a cybercrime or something, what is the purpose? I need to make money, right? Whether ransom or something, and it gets passed on through different accounts, and those are the accounts which are usually mule accounts which get used. And to his point, in terms of if you are able to connect that, then you are able to there is definitely a link between AML and fraud and AML, if you look at it.
In all of these situations, sure, your data may have been digitalized. However, these alerts are sometimes and most of the time being evaluated by people, right? How unique a challenge is this? Is this a critical challenge?
I think, that is if you take all the laws, whatever, everything we discuss and all, but the people who is actually looking at this data and clearing, this is clean or this should be reported, are the people should be trained very well. Because they should be given scenarios, case studies and practicals, the way in which things are happening, and the industry examples, like, each industry, how they can actually manipulate a transaction and they can execute it. So then, so how they get covered. So these people should be trained, for me. Absolutely no question about it, right? So the training is very, very important, because sometimes, because how we point out a mistake actually is an experience, right? Based on the experience only, okay, there is something wrong in this transaction, something is bad. So there is a point, like, how many alerts that generated is get reported.
See, it depends on organization to organization, depends on the quality of the data, how well we have configured the system. But to what you specifically raised, yes. One, when an alert is generated, it's a human in the loop, right? At that point in time, he is the person who determines whether it's a suspicious activity or it's a false positive. If that person does not understand the money laundering schemes, the methodology that is being used, the probability of him identifying it as a suspicious activity may be difficult. And let's also probably put ourselves in his shoes, right? He might get 10 alerts. So for Karthik, if I do multiple transaction, depending on the scenarios that I have configured, there are multiple alerts that will get generated. He needs to make the whole picture of what the different alerts tell him to say that it's suspicious or not. He cannot do it just based on one alert, right? So that is the skill that you need to get your people, especially who are doing this monitoring and alert, to be trained on what they need to look for at a minimum to do.
And that is those in the loop, but then the systems are also being kind of, the alerts are being programmed by people. What was a valid alert 10 years ago is no longer relevant.
Yes, absolutely,
What is-
absolutely. I mean, it's not that you implement it once and forget it. You need to calibrate it every year, at least, if not.
People will find various way to getting a loophole and finding a new ways out to do a money laundering. So anyway, like there is something called ethics and culture, where a person actually have to have their own ethics to do it, right? However, you try to control certain people who is in these criminal activities, they always will try to find the way out. So the people has to continuously learn, right? What are the new ways these people do it? And
We have a concept. See, what we call it, it's like a cat and mouse game, right? A money launderer will always find ways and means to come up with new schemes. It is your job to keep monitoring and identify patterns which come as outliers to see if they are suspicious and report it. It's a cat and mouse game. He comes with a new scheme, you try and find patterns, then create a scenario to monitor it. But then after a few months, he'll come out with another pattern, right? So that game will continue for years to come.
There's one final area of discussion I want to bring in, that is digital currencies. These have now commonly interfaced with traditional financial systems, right? So there is transactions coming in, transactions going out of the system. How challenging has it been for compliance, for institutions that wish to be compliant, the fact that they are now linked to these other digital assets?
So I think moving to digital payment example, right? It's a good initiative, right? So which means all the transaction, cash becomes cashless. Every citizen or every institute, any shops, any boutique should go through that, right? I think India has taken that step now. And then it help in terms of evaluating your AML, detecting suspicious transaction and so on. Again, provided the KYC is up to date, right? So within that, so you make sure that all transaction cashless, it hits your bank account, right? So there are two things happens. When that happens, one is monitoring of AML, and then also revenue for tax or government. That is 2 points. I think mostly the tax evasion happens on that. So I think it's very good in terms of security or the cybersecurity requirements, right? Any payment application, mobile application or internet banking, there is a requirement by the central bank. That's minimum guidelines requirements, standard requirements. And every organization who comes with wallets have to go through that. Annually, they have to do the evaluation by a third party and give a report to them to make sure that those are secure. But although it's annual, that need to be done on a daily basis kind of thing. So, technology is such, minute by minute it changes, vulnerability changes. So you can't be complacent in terms of, okay, I did it 1 year ago. It's still there, but you may be hacked or compromised within a minute. Example, I'll do. We do evaluations, right? We do vulnerability assessment and so on. It's that point we do that, right? The moment that we give the report and we walk out, or maybe while we are doing the final report, there could be another vulnerability coming up. It's a recurrent monitoring. It's not monthly, annually kind of a thing, right? So in terms of cyber and vulnerability fixing and technological risk part of it.
Actually, having digital currency is a good way actually to monitor anti-money laundering, right? Because you have the transaction history of a person, right? If you carry a cash, or maybe if you carry, some other way of payments, sometimes it may be very difficult to monitor, right? But having the current, digital in the sense I'm talking about, using credit cards, it could be debit cards, it could be, right? And also doing online fund
QR code.
transfers, where, you have, but it's a identity profile and you do it. But if you talk about, cryptocurrency, right, then it's where the problem comes, because we don't have a proper regulatory framework to monitor that, right? So there are possible transaction that happen. So we have to see that we give appreciation for the digital wallet in terms of legitimate way, but there's the other side of it which is very, very, very critical, right? I think Karthik, you may have a lot of experience on that subject as well.
Yeah, because even in Sri Lanka, you find things for sale and people say, you can pay me with crypto.
See, that's what I'll tell you. The problem is we for digital transactions. That is always good because cash is difficult to monitor and other stuff. The moment it gets into a digital transaction, it comes through a financial system or it can be monitored. We talking about virtual currency like cryptocurrency. FATF has a whole document talking about the risks of a digital currency, how should it be monitored and all. But let's look at a digital currency. There are countries who do not encourage virtual currency, right? The second problem is a virtual currency transaction happens to a blockchain transaction. Those ledgers may not be available in your country. Tomorrow, if I want to investigate a particular trail of that money, it's not going to be easy for me to do that transactions, right? A person can remain anonymous in doing that transaction. For example, I have a digital wallet sitting somewhere. I transfer that money to somebody else. It does not come into my ecosystem. It's how will I monitor it, right? So that transaction may not be easily monitored. It's just a ledger entry, right, between two different places. The way organizations will have to look at is one, the intersect between your virtual currency and a financial system. At some point in time, you will either go and buy a digital currency. So, for example, there are currency exchanges which will get which are getting what should I say as a regulated entity. So they will tell who has bought how much and at any point in time. Similarly, if somebody is encashing that money, you can do that. But wallet to wallet transaction becomes a challenge to monitor. And the last point where we talk about is a lot of these cyber attacks and others that come in usually get paid in cryptos, right, in some other place.
Yeah.
So because if it's moving from one wallet to another, it's one ledger to another, the international cooperation, which is the basis for fighting money laundering across the globe, and that's where probably the FATF is also getting those standards and pushing everybody to follow standards. One critical element is international cooperation in terms of information exchanges, and that becomes very critical when you want to tackle virtual currency.
Fantastic conversation. Karthik, Gobi, Muzawwir.
Thanks.
Thank you.
Thank you.
Thank
Great
you.
conversation.